The airline industry has been on the rebound since the pandemic as it tries to keep up with the influx of demand. Will it be clear skies ahead, or is turbulence still in the cards for 2023? We have Stephen Trent, who is the Citi research analyst, here to discuss. Great to have you here with us this morning. When you think about the holiday travel that we're seeing and the demand that even coming into this holiday travel season, that airline executives are continuing to point out and say this is either the golden age of travel or that demand is extremely strong. How far does that continue to hold true if we continue to see consumers kind of pull back on some of their discretionary spending?
No, appreciate the time, and thanks very much for having me on. So I do think that this ongoing demand has some legs. You still have a lot of pent-up demand out there from people that have not been able to get out over the last 2 years. So one of the consequences of what seems to be happening in the economy is perhaps a shift from a lot of consumption of stay from home, work from home, pandemic era type items that were very popular to quote unquote reopening. And it sounds stale to say reopening because we've been open. But you have that ongoing shift from goods to services, and you have a dearth of airline capacity per capita that's supporting pricing. So we think that there's still revenue headwind out there over the next couple of quarters.
Well, Stephen, to that point, I mean, man, these stocks have not done well. Considering how much we keep talking about how the travel industry is booming, you know, American down 30% this year, you know, Alaska, Delta down 15%. Why haven't these stocks done better, and what can we expect from them going into 2023?
Sure, great question. So it has been a tough year overall. So, you know, as you said, Alaska is down this year. The S&P is down a little more. So, you know, the broad market has not been easy. We spent a lot of time this year with investors going risk off. We started with Omicron, then we went to a fuel spike. Now we're dealing with higher interest rates. With all of that, we have seen earnings return. We've seen some carriers out there, such as Delta, telegraphing that they will generate multi-billion-dollar levels of free cash flow over the coming years. So I would say there is at least somewhat of a disconnect at the moment between what kind of numbers these companies are putting up and price action in the market. But certainly the market itself hasn't done great. So you actually have seen you know, some carriers do a little better than the market itself, even though they're also down.
Stephen, you have a buy rating on United, and United recently made some headlines with a giant order of some new Boeing airplanes. You know, how do you think those new planes will transform their profits looking out over the next decade?
Sure. So I have to be, you know, maybe I can give you an industry answer on that one. You know, when we've seen across the big three is a need to modernize their fleets, a need to upgauge their aircraft. So moving away from the sub 120 seat range into these larger gauge aircraft that have really good seat mount cross profiles versus the smaller ones. So in terms of what that potentially means from the earnings perspective, I think is kind of the relevant thing to focus on now. Certainly when you get big orders come in, and I'm speaking generally here, definitely there can be some concerns around capex and how a particular airline is going to fund a fleet upgrade. But these fleet upgrades can really make a big difference in terms of economic performance and fuel efficiency. So, you know, I think that's kind of the more relevant piece of the pie longer term, even though a short term, yes, elements of the market could have a knee-jerk reaction to what happens with capex.
Do you believe that that'll drive more of these partnerships, more of these alliances? And we also do have a short clip from the Mesa Airlines CEO off of their most recent alliance. And this is just one of many, but let's roll the clip real quick, and then we'll come back to it on the other side.
When we first wanted to set up a meeting to talk about a wind down, they said, don't even bother coming to Dallas. We don't want to talk about a wind down. In fact, you know, they wanted, not only did they try to incentivize us offered us an extension of the contract. So, I mean, I just have a problem with that because it's, you know, really, denigrates the hard work of all my people. And the bottom line is we went to them because we were losing so much money, $5 million a month, and just said, look, we need to get out so that we can continue to operate the business and provide jobs for 3,500 people.
Okay, and so do you believe that, given what you were mentioning a moment ago in the capex scrutiny, that there could be, if there were just additional planes purchased, that we'll see more of the partnerships like Mesa and United, and even like we had seen in the Northeast Alliance between American Airlines and JetBlue?
Yeah, so I think that we are in a transition period at the moment. So I think there are cyclical things that have been associated with the COVID pandemic. And then I also think there are some structural things. So speaking of the latter, for example, over a long term, regional, I would argue, has been having a tougher time for a while. The market's continuing to move to mainline. Airlines for years have been moving to larger gauge aircraft. And we've seen, for example, all of the major aircraft manufacturers respond to that. All of the newer versions of planes that come out virtually all have more seats on them. So, I think in terms of alliances and what could get agreed to, or what airlines could agree to going forward, absolutely, I think we are going to see kind of out of the box type opportunities to form alliances that will not necessarily be within any particular existing global alliance like Star or Oneworld. So absolutely, I think there's a chance we see more of this because of those structural items that I mentioned.
If we are indeed, and a question on capacity here, I suppose, if we are indeed headed into a recession that's going to dampen the amount of travelers or the propensity for leisure travel, and even see some cutback on corporate travel, which is already trying to rebound to the best extent possible right now, what does that mean for the need for capacity to actually be restored to pre-pandemic levels?
Yeah, absolutely. So, what we've actually seen in our, some of our recent survey work has been a little bit of softness in domestic managed business travel. So I think part of that is, yes, coming from interest rates going higher. Some of that is coming from Zoom and telepresence supplanting some in-person meetings that would have been done on a pre-pandemic level. And then I think you also now have blended business travel. So one of the structural items, for example, is a lot of people are no longer in the office 5 days a week. So maybe they're doing 3 days live and 2 days remote. That creates kind of more flexibility around what we could see in terms of blended trips now, people traveling for business / personal reasons as opposed to a pure business trip. In terms of capacity coming back, and what could happen on the pandemic level, on the economic level with rates going up and maybe some slowdown, a whole bunch of pieces to that. So the other things that we're seeing, for example, is international momentum in several instances is actually overtaking the booking curve momentum we see in the U.S. market. So those network carriers with very good international exposure, very good transatlantic exposure, like Delta, for example, probably going to continue seeing revenue tailwinds as some of these international corridors appear to be 6 to 9 months behind the United States domestic in terms of their recovery. The other thing, high level, that we would be thinking about is if we are indeed going into an economic slowdown, what are the implications for oil prices? So, they have come off a bit. Jet fuel kerosene's come off a little less than oil prices, for example, but they've still come down. So I think the confluence of those factors and some continued shift away from goods and into services is not necessarily a bad setup, for the network majors.
Great analysis for us here today. Citi analyst Stephen Trent, good to see you. Happy holidays.
You too. Thank you.